East Asian markets mostly falling on Tuesday following a sharp retreat on Wall Street. That was fueled by increasing worries about the global economy, while investors, however, said that they were awaiting the Federal Reserve policy meeting that is set for this week. A much-anticipated speech also by President Xi Jinping of China left investors disappointed, as they had been hoping for more comments about stimulus or even clues about the possible reforms to China's economy and as well plans going into next year. After a broadly upbeat start to the week, regional equities were brought back down to earth with a huge bump on Tuesday, with all three main indices in New York tanking following the release of well below par economic data. It was red all across the board for Tokyo's Nikkei, slipping 1.8%. That was down to 21,115 points. The Hang Seng lost just over 1% as well, while the Shanghai Composite was 0.8% cheaper by close, 2,576 points. Out in the United States, Wall Street's three major indices each slid more than 2% on Monday, with the benchmark S&P 500 closing at its lowest level in 14 months. This was on concerns about slowing economic growth ahead of a highly anticipated decision from the Federal Reserve that is expected later this week. On the course, of course, of those interest rate hikes, the Dow Jones Industrial lost 2.1% to 23,592 points, while the S&P 500 was down by a similar market close, 2,545 points. The Nasdaq Composite dropping 2.3%, ending the day at 6,753. As you can tell, the markets across the board looking very dreary as well. Just checking in on how things are going locally, more than 1% lost on the JSE All Share as well. So the picture is slightly negative, but it doesn't seem to be as negative for the Rand. It is getting slightly better, but of course it's still above that 14 Rand key level, and that is bound to hurt. But global markets have been started the last full trading week of 2018 in the red, and this includes the JSE's All Share, which has fallen over 14% since January. But let's check in on the remainder of the European and local markets. As I said a little bit earlier, it is the last full trading week of 2018, and global markets have began that trend in the red, this including the JSE All Share, which has fallen over 14% since January this year. Global indices have been faced with an interest rate normalization period from the United States, a sentiment that the Fed Chair Jerome Powell suggested may begin to slow down as we head into 2019. The U.S. Federal Reserve is expected to begin its final meeting of the year this week as well. Trade disputes between China and the United States have also impacted on global markets. President Donald Trump has taken a hard line against the Asian giant, creating global instability. U.S. stocks retreating to levels last seen in February, while London's FTSE 100 is down 12%. Currencies around the world have also taken a beating, with developments in Brexit cycle also affecting trading this year. Let's unpack as much of it as possible now. Gary Boyson from Rand Swiss joins me at the JSE to perhaps get into the gist of it. Gary, thank you so much for the time, but it is red across the board behind you. More than 1% lost on the JSE. The likes of Sasol, Bidvest, APSA down. Nedbank quite critically down as well today. It hasn't been the rosiest picture this year, and it just seems to continue.
Yeah, we might be seeing the last full trading week for international markets, but we're still playing catch up from the big losses that we saw yesterday while our market was closed. So, you know, a lot of these stocks almost catching up 2 days of losses rather than one. We have started to see the S&P futures and the Dow futures starting to point positive in the early session. So we might be in for a little bit of a dead cat bounce going into this evening's session. But absolutely, today it's carnage. There's not much green on the screen, and as you can see behind me, some big names taking some significant pain.
Yeah, only the DAX there out in Germany seemingly going up, and that's 0.4% on that front. Let's talk about what the year has carried really for a lot of these counters. I mean, we've had so many issues, as I've pointed out there, from trade disputes to Brexit to the oil issues as well, right? Playing all a part in how the markets flowed this year.
It's always difficult to try and pinpoint exactly why markets are getting so nervous, and I think part of it is absolutely the trade wars. The kind of rising populism that we've seen across the globe, the shift to the right. That's definitely played into, I think, the fears around what's going to happen to markets as trade barriers get increased and general global economic activity subsides on the back of that. But I really don't think that we can overestimate how sensitive stock markets, especially equity markets, bond markets as well, are to the likes of this Fed interest rate announcement. So we've obviously got the meeting starting today, and we'll get the announcement in a day and a bit. And what's interesting, we watched something called the Federal Funds Futures to try and give us an indication of how the market is pricing in the moves. So it's widely expected that we will see the US interest rates rise this week, but that expectation has been diminishing. So on Friday there was an 80% chance that we'd see a 0.25% hike from the US. Today it's only 70%, and I think that's partly why we're seeing a slightly firmer currency as markets are trying to price in the expectation that there could be some sort of pause or at least a dovish tone coming from Fed Chair Jerome Powell.
Yeah, so certainly not the expectations of the hike in interest rates happening as quickly as one would have expected. So going into 2019, how does that impact how, perhaps markets are traded then, particularly in the early part of next year?
It's a very good question. So looking at it, at the moment, the Fed has signaled that there should be 3 to 4 interest rate hikes in 2019. The market at the moment is only pricing in around one interest rate hike. So there's a big disparity between what the central bank in the US is saying versus what the market is expecting. Now, that in itself is interesting because that is almost telling us that markets are slightly more optimistic that we're going to get looser monetary policy from the US Fed. And if the Fed does push through with those 3 or 4 rate hikes, I think there could be significant pain, going into 2019. And this could be the end, not going to say the end, but the end of the strong bull run that we've seen in at least the US equity markets and some of the global peers. And this, correction that we're feeling at the moment, and I mean, markets are down significantly from October, could have more to go. We could be facing the next shakeout. We could already be in the next shakeout. That said, if you listen to most economists and you look at kind of business cycle theorists, they're saying that we're moving towards late stage bull market. This is the late stage of the economic cycle. You've got interest rates going up, and while you do get increased volatility in markets, this is still a time where significant gains can be made in markets. I mean, you look at the JSE, for example, we're almost 20% down from highs at the moment. That is significant. It's not anywhere near the 2008 collapse where we were down over 40%. But it's starting to get to a place where you're seeing significant discounts on very, very good quality counters. Now, it's difficult to say whether this is going to turn into an all-out collapse, and I still don't see the fundamental reasons for that. But often they emerge after the fact.
Sure.
Could be trade wars. Could be. I don't think interest rates in themselves are going to be the cause of a collapsing stock market. It could be. Again, will it be the over-leveraged consumers? It's very difficult to tell, and I think that narrative will be generated after we see a proper collapse. But what I can say is that with markets down 20% at the moment, stocks are starting to look like very, very good value. And even if we've got another 20% to go before we rise back to back to square, that's still 20% up if you're buying at these levels. So I think opportunities to be had this December, absolutely.
Yeah, certainly something to look into. A lot of the banks going down as well today. Nedbank, ABSA, First Rand as well in that mix. A lot of it just based on that Nedbank story, though, isn't it?
Well, potentially, and again, it can be fundamentally driven as well. But again, most of the movement that we're seeing today is on the back of I suppose international stock moves as well. It's also just on the back of the very, very subdued South African growth. I think that really is part of the story. We also got the Edcon story coming out over the weekend, which, while Grant Patterson, the CEO, did come back and say that this is very sensationalist reporting and that there is a plan to recapitalize the business. It's it's certainly it's a story in which, you know, if you look at the Edcon story, it's a story in which 140,000 jobs could potentially be lost. The knock-on effect of that in the South African context is probably a million people in South Africa that are going to be directly, you know, or indirectly affected by this. You know, we're having a look at it. You know, the potential shutting of Edcon, which is an extreme example, I mean, could potentially add 1% to our unemployment number. I mean, sure. That's absolutely immense. But you know, on the back of that, obviously, you know, it's telling a story of a very difficult time for retailers. But at the same time, it's also telling a story. You know, it's almost, you know, I think reporting on the market has almost become like wartime journalism. You've kind of got to report as it happens. But you know, there's more to the story as it plays out. And I mean, we are expecting now a deal from Edcon in the next probably, I'd say, at least week or two, where we're going to see a lot more details of a recapitalization of the business and hopefully the saving of those jobs.
Yeah. Gary, we really, really appreciate your time. Just very quickly, as you said there, the retailers suffering a lot. ShopRite down, the Foschini Group down. The likes of Pick n Pay will probably hurt as well. It hasn't been a great year across the board for those, despite what was a fairly good set of earnings out of Pick n Pay a little bit earlier on this year.
Yeah, so again, you look at the retail sector, the whole retail sector is changing. So if you look at it, and that's not just in South Africa, it's globally, with the rise of Amazon and online retail, and retailers that have managed to jump onto the back of the online delivery mechanism have done relatively better. And I'm thinking, in this case, Mr. Price.
Yeah.
Mr. Price has managed to grow its online sales well. The share price has been more robust than a lot of the more traditional retailers. Yeah. But you look at something like Edcon, you look at the traditional brick and mortar retailers, and you know, this year we had Sears going out of business as well, one of the biggest and you know, like a stalwart of the US retail sector, and just because it couldn't move with the times, and because it tried to, you know, continually use an older business model, you know, it was, you know, taken apart by the likes of Amazon and now Walmart, which is catching up. So the whole sector is changing, and I think these businesses have to be very, very dynamic to keep pace.
Gary, you've taken away the festive cheer, so I'm going to leave you to try and enjoy the rest of whatever's possible there. But thank you so much for your time this afternoon, and do have a wonderful festive season, and we'll chat to you in the new year. Gary Boyson from Rand Swiss, as we unpack the market there. A little bit for the year, it has been a tough one for those for those retailers, hasn't it? And even for the world, really, it has been, and that continues to be an issue. He noted there that if Edcon does lose out on those jobs, that's around 1% added to South Africa's unemployment rate. That becomes an issue. And one thing that has also become an issue is that gender gap, hasn't it? The World Economic Forum releasing its global gender gap